Over time, your money can silently grow in the background, like a snowball rolling down a hill. This gradual but powerful increase is known as compounding. Today, we'll delve into this fascinating world and discover how even small, strategic investments can blossom into significant financial achievements in the long run. This captivating journey will equip you with the knowledge and tools needed to unlock the secrets of compounding. We'll explore the mechanics of this concept and provide you with practical strategies to transform your financial future. In the realm of personal finance, compounding stands out as a reliable and well-tested path toward building long-term wealth. By understanding and harnessing its power, you can take control of your financial well-being and achieve your long-term goals. So, how does this work? Compounding involves putting your earnings back to work. Imagine your initial investment as a seed. When you reinvest your returns, it's like planting that seed and allowing it to grow into a new plant. This new plant then produces its seeds, returns, which you can also reinvest, creating an even larger cycle of growth. The power of compounding allows individuals to accumulate significant wealth over time and potentially reach their financial goals. Throughout this video, we'll break down the core principles of compounding, explore its advantages, and discuss some of the most effective investment options that can leverage this powerful concept to pave the way for financial success. Before diving into specific assets, let's ensure a clear understanding of compounding itself. Often referred to as the eighth wonder of the world, compounding holds exceptional power to grow investments exponentially over extended periods. In simpler terms, compounding involves reinvesting your profits. This can be earnings from dividends, interest, or capital gains on your initial investment. By reinvesting these returns, you allow them to generate additional income on top of the original amount. The true magic of compounding lies in its ability to snowball. You earn not only on your initial investment, but also on the accumulated returns. As time progresses, this effect accelerates, leading to substantial wealth accumulation in the long run. Compounding is just as if you're holding a small snowball at the top of a snowy hill. That snowball represents your initial investment, say $10,000. Now, picture yourself rolling it down the hill. As it gathers snow along the way, it gradually grows in size. This perfectly illustrates the snowball effect of wealth accumulation through compounding. Let's dive deeper with a practical example. Suppose you invest $10,000 in an asset that generates an average annual return of 8%. This means that every year, you earn 8% interest on your investment. Year 1. In the first year, your initial $10,000 earns an interest of $800, 8% x $10,000. This is added to your principal amount, bringing your total investment to $10,800. Year 2. Now things get interesting. The 8% return isn't just calculated on the original $10,000. Remember, your investment has grown to $10,800. So in year 2, you earn $864 in interest, 8% x $10,800. This might seem like a small difference, but it highlights the power of compounding. Year 3. Here's where the snowball truly starts rolling. Your investment amount has grown to $11,664, $10,800 plus $864. This year, you earn $933.12 in interest, 8% x $11,664. Notice how the interest amount keeps increasing because you're not just earning on the original investment, but also on the accumulated returns from previous years. This is the magic of compounding. Over time, as your investment continues to grow, the interest you earn also increases. It's like adding more snow to your snowball with each roll down the hill. Fast forward 30 years. Following this hypothetical scenario, with consistent 8% annual returns and reinvesting all earnings, your initial investment of $10,000 could blossom into approximately $341,000. This significant growth is solely due to the power of compounding. This is a simplified example, and actual returns can vary depending on the chosen investment and market conditions. However, it effectively demonstrates the potential of compounding to dramatically increase your wealth over the long term. While the previous example showcased a significant increase, it's important to note that a more realistic scenario might result in a total of approximately $106,626 after 30 years with a consistent 8% annual return and reinvested earnings. This emphasizes the importance of considering realistic expectations based on market conditions. The key takeaway is that interest accumulates not just on the initial investment, but also on the accumulated interest from previous years. This reiterates the core concept of compounding. This compounding effect acts as a powerful multiplier, significantly amplifying the growth potential of investments over extended periods. This emphasizes the significant impact of compounding over time. Over a long-term investment horizon, compounding can be a significant wealth-building tool. This clarifies the benefit of a long-term approach for maximizing the impact of compounding. Now that we've established a strong understanding of compounding, let's explore some potential investment options that can leverage this powerful concept. This creates a smooth transition to the next section. Disclaimer: while the following options have historically exhibited the potential for compounding, it's crucial to remember that individual results may vary depending on market conditions, chosen investment vehicles, and risk tolerance. 1. High-yield savings accounts. These accounts offer competitive interest rates compared to traditional savings accounts. They are a suitable starting point due to their low minimum investment requirements and minimal risk. While returns might be modest compared to other options, they provide a safe and accessible way to begin your journey with compounding. Let's illustrate the concept with a practical example. Imagine you deposit $10,000 in a high-yield savings account offering a 2% annual interest rate compounded annually. After 10 years, your investment could potentially grow to around $12,189. This growth showcases the power of compounding. Even a seemingly small interest rate can accumulate significantly over time, contributing to the overall growth of the account. High-yield savings accounts are ideal for short-term goals like down payments or emergency funds. They offer a haven for your money with government insurance, easy access when needed, and the benefit of compounding interest for steady growth over time. Additionally, convenient online features make managing your account a breeze. However, it's important to acknowledge that high-yield savings accounts typically offer lower returns compared to other investment options. This is because they prioritize safety and liquidity over maximizing growth potential. Jumping to the next asset class. 2. Stocks. Stocks offer ownership in companies and historically deliver strong long-term returns, making them a popular choice for building wealth. Companies with consistent growth and strong financials have the potential to outperform other assets. By diversifying your portfolio with such stocks, you spread risk and leverage compounding for long-term gains. While historical data suggests average annual returns for stocks might range between 7% and 10%, it's crucial to remember that past performance is not always indicative of future results. Stock markets are inherently volatile, and individual returns can vary significantly depending on market conditions and the specific companies chosen. Here's a hypothetical scenario for illustration purposes. Imagine you invest $10,000 in a diversified stock portfolio with an assumed average annual return of 8%. After 10 years, your investment could potentially reach approximately $21,589. Disclaimer: this is a simplified example and does not guarantee future results. 3. Dividend-paying stocks. Owning dividend-paying stocks offers a three-pronged benefit: potential for capital appreciation as the company grows, a steady stream of income through regular dividend payments, and the ability to reinvest dividends for accelerated compounding, making them attractive assets for wealth creation. Here's how dividend-paying stocks can contribute to wealth creation through compounding. Dividends can be reinvested to buy more shares. This increases your ownership stake in the company and allows you to benefit from future price appreciation and dividend payments on those additional shares. Compounding on both income and capital gains. As the company grows, the dividend amount may increase, and the stock price may also be appreciated. This creates a dual compounding effect on your investment. Selecting dividend-paying stocks requires looking beyond just the headline yield. While a high dividend yield might be tempting, prioritize the company's financial health and ability to sustain such payouts. Analyze the payout ratio to ensure the company isn't sacrificing future growth for dividends. Focus on companies with a history of consistent dividend payments, strong financials, and increasing dividends for a reliable income stream. A prudent strategy involves selecting well-established companies with a proven ability to maintain consistent dividend payments and a potential for future growth. This video has explored the magic of compounding and its potential to supercharge your wealth creation. Remember, the key is to start early, invest consistently, and embrace a long-term outlook. While the discussed options have historically benefited from compounding, individual results can vary based on market conditions, your chosen investments, and risk tolerance. Building a secure financial future requires a personalized approach. Therefore, consulting a qualified financial advisor is crucial. They can tailor an investment strategy to your specific needs, navigate options, and monitor your portfolio. By harnessing the power of compounding alongside professional guidance, you'll be well equipped to achieve your financial goals. Remember, additional resources like financial literacy websites can further empower you on your financial journey. Compounding rocks, but remember, it's your journey. Dive deeper, do your research, tons of resources online. And don't be shy. Chat with a financial advisor. It's all about you. Start early, invest regularly, and get some pro help. That's the recipe for a bright financial future. Oh, and keep an eye on the market. Knowledge is power.